The question which we are going to do is of 5.2.1. It is of other methods. Project K has an initial investment of 10 lakhs. Its cash flows for 5 years are given. Determine the payback assuming a discount rate of 10%. Now, if the discount rate is given, I will be finding out a discounted payback. Instead of payback, I'll be finding out discounted payback. Let us understand initial investment is 10 lakhs. One, two, three, 4, and 5. The cash flows are 3 lakhs, 3,60,000. Yes. Let us continue. It is first year 3 lakhs, 3,60,000. Again 3 lakhs, 2,64,000. And 2,40,000. These are the 5 years cash flow which are given: 3 lakh, 3,60,000, 3 lakh, 2,64,000, and 2,40,000. Determine the payback period assuming a discount rate of 10%. So at what rate I will be discounting this cash flow? At the rate of 10%. Now I will have to find out individual figures. I cannot do the total. I don't want NPV. I want individual figures. So present value at the rate of 10%, I'll be finding it out. 3 lakh divided by 1.1 is 2,72,727. 272,727. 3,60,000 divided by 1.1 is equal to 297,520. 297,520. Third is 3 lakh divided by 1.1 is equal to 225,394. 225,394. 2,64,000 divided by 1.1 is equal to 4 times 180,315. 2,40,000 divided by 1.1, 1, 2, 3, 4, 5, 149,021. What I have found out? Present value, individual figures for all 5 years. What I need to do? I need to recover my 10 lakhs rupees from this cash flows. What is the first idea? I will be finding out cumulative cash flows. Cumulative cash flows. These are cash flows. These are cumulative cash flows. First year it remains same, 272,727. Second year, total of first and second year, 272,727 plus 295,297,520. 570,247. Again 570,247 plus 225,394. 795,641. Again 1,80,315 added to it. 795,641 plus 180,315. 975,956. 975,956 plus 149,021. 11,24,977. 11,24,977. When my initial investment of 10 lakhs will be recovered after 4 years. So I am taking fourth year as a base. Right? And I am using the formula which I have derived for payback period. It is base rate plus cumulative cash flow, initial investment minus cumulative cash flow of base year divided by cash flow of base plus 1 year. Base rate is 4 plus initial investment is 10 lakhs minus cumulative cash flow for base year is 975,956 divided by cash flow for base plus 1 year. Base is 4 plus 1 is 5, 149,021. As I told you, you can even do it logically. This is just a formula by which in examination you can do it very fast. 4 plus, I will be directly finding out answer. It is 10 lakhs minus 975,956. This is the amount of investment that I need to recover in fifth year. But I am recovering 149,021 divided by 149,021. So it will take only 16% of a year to recover this money. Plus 4 is 4.16 years. So can't we do it logically? You can do it logically. I'm using the formula. You can easily do it logically. As the fifth sum in our normal question, this is again excellent question. We'll be doing it after a point of time. Let us first revise some of the concept of NPV, IRR, payback and other things. We are going to 5.2.3. C Limited is considering investing in a project. Expected investment in the project is rupees 2 lakhs. With project life of 5 years and no salvage value, net cash inflows after depreciation but before tax during the life of the project will be. What is this? Net cash inflows after depreciation but before tax. Try to understand whenever this type of confusion comes. No cash inflows can be after depreciation. They are trying to say it is profit. It is profit after depreciation but before tax. So depreciation is already deducted. Will I have to prepare for all 5 years? Yes. I will have to prepare it for all 5 years. I am not having any other option. 1, 2, 3, 4, 5 years. This is profit after depreciation but before tax, which is nothing but PBT. Depreciation is deducted but tax is yet to be deducted. It is 85,000, 1 lakh, 80,000. As the figures are different, I'll have to prepare it separately. Also, I want to find out payback period. So I am not having any other option with me. 40,000. The project will be depreciated at a rate of 20% of original cost. The company is subject to 30% tax rate. There is no salvage value. Calculate payback period, average rate of return, NPV, net present value index is PI. Net present value is NPV, index is nothing but PI. If cost of capital is 10%. Also, you need to find out IRR. So practically, this can become a good question for revision. It covers practically each and every method. So the first, my answer is PBT. I will find out answer of PAT. If the tax rate is 30%, PAT will be 70%. 70% of 85,000. This we all know, right? 30% tax rate. After tax, it will be 70%. 1 minus t into 0.7. 59,500. 1 lakh into 70% is 70,000. This is 56,000. This is 56,000. This is 28,000. This is profit after tax. I need to add depreciation to it to get answer of cash flows. So we will be adding depreciation. Now what will be depreciation? The project will be depreciated at a 20% on original cost. What is original cost? 2 lakh rupees. So every year depreciation will be 20% of 2 lakhs, which is 40,000. So practically it will be depreciated in 5 years. The project life is 5 years. It is the straight line method. Even if it is given in percentage terms, it is given on original cost. So every year 40,000 will be depreciation. I need to just add 40,000. I need to just add 40,000 in my profit after tax. So depreciation is 40,000. I am finding out cash flow. 59,500 plus 40,000 will be 99,500. 40,000, 1 lakh, 10,000 plus 40,000, 96,000 plus 40,000, 96,000, 40,000, 68,000. At the end of the 5 years, I will be getting salvage value, which is 0. If it is a straight line method, there will be no profit or loss on sale of machinery. So there will be no profit or capital gain, which will be coming into picture. So I think we have covered this point, which is cash flows. I need to find out present value. What is the cost of capital? 10%. So I need to find out present value at the rate of 10%. Present value at the rate of 10%. Sir, can't I find out the total answer? Yes, you will need a total answer to find out NPV. But you will also need individual answers to find out your payback period. So I am finding out in individual terms. 99,500 divided by 1.1. 90,454. 1,10,000 divided by 1.1 is equal to 90,909. 96,000 divided by 1.1 is equal to 72,126. 96,000 discounted 4 years. 1, 2, 3, 4. 65,570. 68,000 discounted 5 years. 1, 2, 3, 4, 5. 42,222. Total present value of cash inflow. I can easily make the total. 90545 454 plus 90909 plus 72126 plus 65570 plus 42222. 361,281 is the present value of cash inflow. Minus present value of cash outflow, which is 2 lakhs. I have got my first answer, which is NPV, 1,61,280. So this is my answer number 3. Also in answer number 3, they are asking me PI. PI is present value of cash inflow divided by present value of cash outflow. It is 361,281 divided by 2 lakhs. .81 or 1.806 is my PI. They are telling me to find out payback period. Answer number 1. Payback period. I need to recover 2 lakhs rupees. For that, I'll have to find out cumulative cash flows. Cumulative cash flows. I am drawing another column. Cumulative cash flows. This will be 9454. 9454 plus 90909 181,363 181,363 plus 72126 253,489. Now try to understand between second and third year, my payback period will come. Payback period is between second and 3. So after 2 years, payback period will come. So I don't need to find out cumulative cash flows ahead. They are not important for us. What I'll be taking as my base year is second year. I will be using directly formula. Base year plus initial investment minus cumulative cash flow of base year divided by cash flow of base plus 1 year. Base rate is 2 plus initial investment is 2 lakh minus 181,363 divided by cash flow of third year, which is 96,000. Sorry, it is 72,126. Discounted cash flow is 72,126. 72,126. I will be getting my payback period 2 lakh plus 181,363. 2 lakh minus 181,363 divided by 72,126 plus 2.26 years will be nothing. Discounted payback. Whenever it is possible to find out discounted payback, always find out discounted payback. Next is average rate of return or accounting rate of return. Answer number is second. ARR. All right. How to find out? Average profit divided by initial investment multiplied by 100. Sir, is profit available? The answer is yes. Which is the profit column? Please try to concentrate. This is the profit column. These are cash flows. These are discounted cash flows. In accounting rate of return, if profit is available, we always consider profit. So let us consider profit and we will be finding out average. 59,500 plus 70,000 plus 56,000 plus 56,000 plus 28,000 divided by 5. This is my average profit, 53,900. Average profit is 53,900 divided by initial investment 2 lakhs multiplied by 100. 53,900 divided by 2 lakhs multiplied by 100. It is 26.95. I have solved payback period, average rate of return, very simple, based upon formula NPV and PI. What is remaining is IRR, internal rate of return. For IRR, you might not need to write down, but I need to write down cash flows again. Discounted cash flows are 9454. 9909, 72126, 65570, and fifth year is 4. These are my discounted cash flows. How to find out IRR? We know that at 10% NPV is positive. So the project is earning more than 10%. That is for sure. Now, sir, more than 10%, we should try trial and error from 11%, 12%, 13%. What you should try out? But in this question, they have given it that try this. We first need to try out 10%, which we have already found out, then directly 37%. Okay, so I need not take discounted cash flow. Those are discounted cash flow at the rate of 10%. So this is not correct. I need to take only cash flows. I will be finding out discount on my own. Discounted cash flows on my own. 99,500, 1,10,000, 96,000, 96,000, 68,000. I will be finding out present value at the rate of 37%. Why I am directly trying it at 37%? Because the sum is giving me hint. Now you can use M plus concept, right? Now you don't need your payback period, so you can use your M plus concept. It is 99,500 divided by 1.37 is equal to M plus 1,10,000 divided by 1.37 is equal to M plus 96,000 divided by 1.37 is equal to M plus 96,000 divided by 1.37, 1, 2, 3, 4 M plus 68,000 divided by 1.37, 1, 2, 3, 4, 5 M plus. MRC is 2,09,910. 2,09,910. This is present value of cash inflow at 37%. Present value of cash outflow is 2 lakhs. My positive NPV will be 9910. Still, I know that my IRR is greater than 37%, but I don't know how much exactly it is. I will require one answer which is negative NPV. So let me take a higher percentage. So you need to again find out at 38%, because the question says you'll have to do trial and error of that percentage. So at 38%, I am finding out present value. Present value at the rate of 38%. See, in book they have given all the figures. It is not required. You can always do this in examination. You can keep this blank, directly find out present value at the rate of 38% in your calculator. I am directly taking it from book. 2,06,560. Now, once you are getting 2,06,000, don't worry about remaining figures. It might be 222, 226 for you, because it depends how you are finding out present value. If you are rounding off your present value factor at 2 decimal, your answer will be different. Otherwise, your answer will be different. But till the time it is 2,06,000 something, your answer is all right. Again, it is coming 2 lakhs rupees and it is a 6560. Again, the answer is positive. I will now try it at 40%, which the book is only giving me that which percentage I should try it out. The question itself is giving me. So I am trying out at 40%, present value at the rate of 40%. Present value of cash inflow will be 99,500 divided by 1.4 is equal to M plus 1,10,000 divided by 1.4 is equal to M plus 96,000 divided by 1.4 is equal to M plus 96,000 divided by 1.4, 1 2 3 4 M plus 68,000 divided by 1.4, 1 2 3 4 5 M plus MRC is 199,812 minus 2 lakhs rupees. So my NPV will be 199,812 minus 2 lakhs. It is 188. So it is very near to 40%, right? Because this is very near to 0. But still we'll be using interpolation technique and find out IRR. Please understand this figure might be different if you use different technique for finding out present value. In book they have taken 3 decimal in book. We are taking all the decimals which are available in calculator. We are doing it with M plus, so the answer would be different. Anyone in class who has got at 40%? Those who have found out at 40%? Yes, what is the answer? Alright, so this is correct. I am finding out my fourth answer, which is IRR. Base rate will become 38% plus positive NPV divided by difference of NPV multiplied by difference in rate. Base rate is 38, positive NPV is 6560 divided by difference in NPV is 6560 plus 188, 6748 multiplied by 2. 6560 divided by 6748 multiplied by 2. Yes, plus 38, 39.94. And what is our IRR? Our IRR is 39.94. Good question. The day before examination, because it covers each and every method. Question number 4 is your homework. We are doing 5. Again, it is a concept of discounted payback and for two machines. This is just a repetition. I am going to do machine 1 in classroom. Again, machine 2 will become your homework. It is just a repetition. Let us solve this. The PQR Company Limited is considering to select out of two mutually exclusive machines. The company's cost of capital is 12% and corporate tax rate is 30%. Other information is as follows. Machine 1, machine 2. Cost of the machine 15 lakhs. Expected life for 5 years. Before tax and depreciation. So it is PBIT. 6,25,000. So for all 5 years, everything will remain same because depreciation is on SLM basis. Discounted payback, net present value and profitability index. See, this discounted payback creates a problem. Why? Then we need to find out for all the years their present value. So please understand, I cannot do sum like this, 1 to 5 years. I know the cash flow is going to remain same. What will be cash flow? I will tell you. Profit before depreciation and tax is 6,25,000. As I told you, I will be doing only machine 1. Minus depreciation. Depreciation on straight line basis is a cost divided by number of years. Scrap value I am assuming 0. So this will be 3 lakhs. Profit before tax will be 3,25,000. Minus tax, I will be getting profit after tax. Tax rate is 30%. So profit after tax will be 70%. 3,25,000 into 70%. 2,27,500. This is profit after tax plus depreciation of 3 lakhs. So it is 5,27,500. Will be cash flow for which year? 1 to 5 years. Sir, I can easily find out total present value. Agreed. But I will have to do this. 1, 2, 3, 4, 5. What is cash flow for first year? 527,500. Second year 527,500. Third year 527,500. Fourth year 527,500 and fifth year 527,500. Sir, it is not required. I can easily find out present value of cash inflow without writing this 5 figures. I absolutely agree. It is very simple. Present value at the rate of 12%. Do this. 1 divided by 1.12, 5 times is equal to GT multiplied by 527,500. 1 divided by 1.12 is equal to 5 times GT multiplied by 527,500. It is 19,01,519. 19,01,519 minus present value of cash outflow is 15 lakhs. So NPV is 4,01,519. I can also easily find out PI will be 19,01,519 divided by 15 lakhs. $1.27 will be my PI. The problem is why I require to write down this all 5 years, because I need my discounted payback period, and for discounted payback I want individual figures, and I am finding out individual figures. 527,500 divided by 1.12 will be 470,982. 527,500 divided by 1.12 is equal to 420,519. 8 lakhs approximately is recovered. 527,500 divided by 1.12 is equal to 375,464. How you are doing it? You should not do like me. What you should do? 527,500 divided by 1.12. Keep your calculator as it is and write down the figure 470,982. Press one more times is equal to write down this figure. Press one more times is equal to write down this figure. You can just you don't have to repeat each and everything. 470,982. 527,500 divided by 1.12 is equal to 335,235. And probably this figure will not be required, but still I can find it out. 335,235 divided by 1.12, 299,316. I will require cumulative cash flows because I want payback period. 470,982. I need to recover 15 lakhs, right? 470,982 plus 420,519. 891,501. 891,501 plus 375,464. 1266,965. plus 335,235. 16 lakh 2,200. 16 lakh 2,200. Fifth year cumulative cash flow will not be required. My base year will become third year. I will be using the formula for payback period and finding out the answer. Base year so base year is 3 plus 15 lakhs minus 1266,965. It is 2,33,035. Divided by cash flow of fourth year, not cumulative cash flow. 335,235. So the answer of 233,035 divided by 335,235 plus 3 is a 3.6 or 3.70 is the payback period. NPV is rupees, PI is times, or you cannot write, you can write on just 1.27, and payback period is in years. Machine 2, similar way, just the figures will be different, otherwise same question will be there. If you want to take a decision should be based on NPV. Why it should not be based upon equalized annual NPV? Because this is 5 years, this is 5 years. If the time period is same, you can take a decision by NPV. If time period is different, you will have to take decision by equalized NPV. This is a 5.2.5. Next question, 5.2.6, similar type of question. You should be able to do it. We are going to 5.2.7. AT Limited is considering three projects A, B and C. The cash flow associated with the projects are given below. So project A, B and C cash flows are given. C0 is time period 0, that is today. C1 is after 1 year, cash flow after 2 years, cash flow after 3 years and cash flow after 4 years. You are required to calculate the payback period of three projects. I will not be finding out a discounted payback. Sir, why rate of return is not given? It is given, but it is given only for NPV. Projects with positive NPV, if opportunity cost is 10%. So for payback, any rate is not available. I will be finding out simple payback. If the cutoff period is 2 years, this I'll explain you. This and this I'll explain you. First, let us find out payback period and NPV. So first, I'll be finding out simple payback period of project A. Project A, what are the cash flows? Today, there is a cash outflow of 10,000. Then 2,000, 2,000, 6,000, 0. 2,000, 2,000, 6,000, 0. 1, 2, 3, 4. First, I am finding out payback. I want to recover how much? 10,000 rupees. I am finding out cumulative cash flows. This is 2,000. This is 4,000. 4 plus 6 is 10,000. Was not required, but still it is 3 years. I am finding out NPV also. NPV at the rate of 10%. Present value of cash inflow at the rate of 10%. I can directly find out in my M plus, right? 2000 divided by 1.1 is equal to M plus. 2000 divided by 1.1 is equal to M plus. 6000 divided by 1.1 is equal to M plus. MRC is 7978. 7978. It will be negative. This is present value of cash inflow. Present value of cash outflow is 10,000. 7978 minus 10,000. Negative 2022. This is for project A. You need to do it for B and C also. I want two answers, payback period as well as NPV. I am doing project B. Project B is negative 2000, 0, 2000, 4,000, 6,000. Third and fourth year. Payback period is not 1 year. First year you are earning 0 rupees. Second year you are earning 2,000 rupees. So payback period is 2 years. I will be finding out present value of cash inflow at the rate of 10%. It is 2000 divided by 1.1 is equal to because it is after 2 years. M plus 4,000 divided by 1.1 is equal to M plus 6,000 divided by 1.1 is equal to M plus. MRC is 8756 minus present value of cash outflow is 2000. This is 6756. This is project B. Project C 0, 1, 2, 3, 4, 10,000, 2 to 610. 10,000, 2,000, 2,000, 6,000, 10,000. Payback period is 3 years. I need to find out present value of cash inflow at the rate of 10%. 2000 divided by 1.1 is equal to M plus. 2000 divided by 1.1 is equal to M plus. 6000 divided by 1.1, 1, 2, 3, M plus. 10,000 divided by 1.1, 1, 2, 3, 4, M plus. MRC is 14809 minus present value of cash outflow is 10,480 will be my NPV. I am drawing a summary of project A, B and C. A, B, C, payback period, NPV. C, payback period is 3 years. NPV is 4809 positive. Project B, NPV is 6756. Payback period is 2 years. Payback period is 3 years. NPV is negative 2000. All of you have reached up till this stage. Payback period of all 3 projects are available and NPV of all 3 projects are available. Let us solve this question first. If cutoff period is 2 years, then which project should be accepted? See, what is cutoff period? Why we find out payback period? We know lesser the payback period is less risk. So the person who is investing this all money, say AT Limited, says that we do project which is having payback period of 2 years or less. So our initial investment should be recovered in 2 years. Otherwise, we don't do the project. That means this. Cutoff period is 2 years. What does it mean? The company will accept the project only if the payback period is 2 years or less than 2 years. More than 2 years, they feel it is too much risky. Then which project should be accepted? Only one, which is B. It is having positive NPV and it satisfies the criteria of cutoff of 2 years. Project with positive NPV we have done. B and C are with positive NPV. Alright. D is good. Please understand, this is a logical understanding of payback period. If you don't know logically, you will not be able to solve it. It was asked in 10 marks. Payback period gives too much weight to cash flows that occurs after the cutoff date. True or false? Payback period, say here it is 2 years. Payback period gives more weightage to the cash flows which are out of after cutoff date. Those cash flows are out of cutoff date. The statement is false. It does not give any importance to the figure which is out of after cutoff date. Yeah, see, instead of this 4,000, it was suppose 4 lakhs rupees. My payback period would still be 2 years. I need to recover my 2,000, which is recovered in second year. So my payback period gives zero importance to the cash flow which are after the cutoff date. Here cutoff date is 2 years, right? So the statement is false. Good question asked by institute. And now they are trying to ask one more comment. If a firm uses a single cutoff period for all projects, see what was cutoff period for the company? 2 years. They are saying if the firm uses single cutoff period for all projects, it is likely to accept too many short-lived projects. See, if the cutoff period is 2 years for the company, this type of company will always do some projects which are short-term, and they will never be able to do the projects which are long-term. Say long-term projects, car manufacturing company, aeroplane manufacturing company, it will take 2 years to start the project. So your initial investment will never be recovered in 2 years. So long-term projects always requires more cutoff period. So this is the true. If firm uses single cutoff, which is 2 years, then it will be always taking up the projects which are short-lived. This statement is true. Previous statement was false. Payback period does not give any importance to the cash flow which happens after cutoff date. That is what we have learned in D. I think it is an excellent question. Should be repeated sometimes in examination. Once it is repeated, it becomes a very easy question, right? Because we know conceptual idea of payback period. What I say is this point is good, because it explains you the logical idea of payback period rather than just formula for payback period. Question was 5.2.7. We are first doing question of equalized annual NPV. There are 3 questions which are for equalized annual NPV. We will be doing 2 and we will be keeping 1 as homework. First, try to concentrate this. Many a times in some projects, like say in this project, I want to purchase a car or I want to purchase a car. Car is say I-20. This is also I-20. But this is petrol. This is diesel. Is this a capital budgeting decision? The answer is yes. Should I purchase a petrol car or should I purchase a diesel car? There is a cost of the car given. Repairs and maintenance is given. Petrol cost is given. Insurance and other cost is given. The problem is I cannot take the decision with NPV. For NPV, I need cash inflows. If I purchase the car, what will be cash inflow? Zero. There is no cash inflow if I purchase the car. I am purchasing it for my own transportation or just for leisure. I want to say that I am having a car, so I am purchasing it. Still, I want to find out I should purchase a petrol car or diesel car. There is no cash inflow. Then how do you take NPV? Because NPV is present value of cash inflow minus present value of cash outflow. Anyone who can help me out? How I will be taking a decision whether I will be purchasing a petrol car or diesel car? There are only cash outflows in both the cases. Try to concentrate. I'm telling you. I will find out present value of cash outflow for I-20 and say it is 2 lakhs. It will never be 2 lakhs. Let me take it 10 lakhs. What is present value of cash outflow in petrol car? It is present value of all cash outflows. Huh? I have assumed the car will run for 10 years, all 10 years. I have decided petrol cost and everything I have adjusted. And what is the present value of cash outflow? Because there are only outflows, I can find out present value of only cash outflow. Here also, present value of cash outflow comes 12 lakhs rupees. So try to understand, including all expenditure, converting all the values today, that is present value, this car is costing me 10 lakhs and this car is costing me 12 lakhs. Now we are not in NPV, we are just in present value of cash outflow. cash outflow, lower is better. I will be selecting this option. I'm not having NPV, but I need to purchase one car. There are only cash outflow. I will be finding out present value of cash outflow, present value of cash outflow of another option. Where the present value of cash outflow is lower, I will be selecting that particular car. So if it is NPV, it is a higher figure. But if it is just present value of cash outflow, it is a lower figure and I'll be taking a decision. See, in this equalized annual NPV, till now, whatever questions are asked, always it is asked in such a manner that there are only cash outflows. There are no cash inflows. Let us solve this. APZ Limited is considering to select a machine between two machines A and B. Two machines have identical capacity, do exactly the same job but designed differently. Machine A cost rupees 8 lakhs, having the useful life of 3 years. It cost 1,30,000 per year to run. Machine B is an economy model, 6 lakhs, useful life of 2 years, 2,50,000 per year to run. The cash flows of the machine A and B are real cash flows. The costs are forecasted in rupees of constant purchasing power. Ignore taxes. Once I ignore taxes, I'll be even ignoring the depreciation. The opportunity cost of capital is 10%. Present value factor are 10%. Of 10% are given. I am first doing only for machine A. Try to concentrate. Machine A, at the end of 0 year, I will be having a cash outflow of 8 lakhs. Having a useful life of 3 years. So first, second and third year, it cost me, again it is a cash outflow, 1,30,000, 1,30,000, 1,30,000. These are real cash flows. So they are cash flows given. I will be finding out present value at the rate of 10%. Now, if I find out present value at the rate of 10%, I will be getting present value of cash outflow only. Because there are no inflows. Everything is outflow, so I will be getting present value of cash outflow. Very simple, 1,30,000, you can do it by GT. 1 divided by 1.10 is equal to GT multiplied by 1,30,000, and then you can just add 8 lakhs rupees. I will just ignore negative sign, right? Everything is outflow. So it is 1 divided by 1.1 is equal to GT multiplied by 1,30,000 plus 8 lakhs. It is 11,23,290. 11,23,290. I am doing for machine B. Machine B in 0 year it will be negative 6 lakhs. 1, 2 and 3 years it will be 2,50,000 outflow. 2,50,000 outflow, 2,50,000. Just find out present value of cash outflow. I cannot find out NPV. I will have to find out present value of cash outflow. 6 lakhs is itself a present value. 2,50,000 I need to find out present value. It is 12,21,713. Sorry, it is my mistake. 2,50,000 is just for 2 years. It is not for 3 years. So I'll have to find out present value of cash outflow. 1 divided by 1.1 is equal to M plus MRC multiplied by 2,50,000 plus 6 lakhs. 10,33,884. Can I take the decision by present value? The answer is no. Why? One project is of 3 years. One project is of 2 years. You should never take a decision based upon present value. Sir, which decision we were going to take this? No. If it is only cash outflow, lower is better. So I am going to take decisions of machine B. But I should not take. Which decision I should be taking is equalized annual. It is by equalized annual present value of cash outflow. How to find out? This is for 3 years. The rate is 10%. We have done it in introductory session. 1 divided by 1.10 is equal to m plus is equal to m plus is equal to m plus. I told it to you by GT, right? 11 lakh 23,290 divided by MRC. See what is divided? Instead of divided by 3, I am doing divided by 2.4868, right? Which is 4,51,691. 451,691. I don't do divided it by 3. I do divided it by present value annuity factor of 3 years at 10%. This will be divided by 2. Yes or no? No. It will be divided by present value annuity factor of 2 years. 1 divided by 1.1 is equal to m plus is equal to m plus. So that factor is in my MRC. 10,33,884 divided by MRC is 595,714. If it was NPV, it will be equalized annual NPV. If it is only present value of cash outflow, it will be equalized annual present value of cash outflow. Which machine I should select? Machine B. No. This is only cash outflow. Cash outflow, lower is better. Which is lower? Project A. I will be selecting project A. Five point 3.2 is your homework. Alright, 5.3.3 is also similar type of question, but I am changing it somewhat. Because 2 and 3, 1, 2 and 3 all are same, right? We should not just repeat it. I will be changing it somewhat. A company is required to choose between two machines A and B. The two machines are designed differently but have identical capacity and do exactly the same job. Machine A cost rupees 6 lakhs, will last for 3 years, 1,20,000 per year to run. Machine B is an economy model costing rupees 4 lakhs but will last only for 2 years and cost 1,80,000 per year to run. These are real cash flows. The costs are forecasted in rupees of a constant purchasing power. Opportunity cost of capital is 10%. Which machine should company buy? Ignore tax. Cancel this. Tax at the rate of 30%. Alright, machine A, I am first solving it. 0, machine A cost rupees 6 lakhs, last for 3 years, cost 1,20,000. 0, 1, 2, 3. Negative 6 lakhs. Negative 1,20,000 negative 1,20,000, negative 1 lakh. You can do first, second and third year together. It does not make any difference. All right. See, when we ignore tax, we can ignore depreciation because depreciation is non-cash. There is no requirement of non-cash as far as your finance is concerned. But whenever there is a tax, now depreciation will become important. Not exactly depreciation will be important, but there will be a cash inflow which is tax benefit on depreciation. Now, how to find out the tax benefit on depreciation? First, what will be depreciation for all 3 years? 2 lakhs rupees. Straight line method, cost upon n, 6 lakh divided by 3 is 2 lakhs rupees. So, every year, what will be tax benefit from depreciation is 60,000 rupees. Whenever you will file income tax return of your business, there will be depreciation of 2 lakhs rupees because of this machine, and so you will end up paying 60,000 rupees less tax because of this depreciation. So I am directly considering tax benefit on depreciation every year. Tax benefit on depreciation is your cash inflow, and I will be getting my net cash flows. Negative 6 lakhs, negative 60,000, negative 60,000, negative 60,000. I will be finding out present value of cash outflow at the rate of 10%. 60,000 divided by 1.1 is equal to m plus. No, 60,000 I can take common. 1 divided by 1.1 is equal to m plus is equal to m plus is equal to m plus. If you are having GT, you should always use GT multiplied by 60,000. 149,211 plus 6 lakhs. 749,211. Second machine is of 2 years. So I will even require equalized annual present value of cash outflow. I am teaching you by GT. Just do this. 1 divided by 1.1 is equal to is equal to is equal to. So 3 years factors are added. 749,211 divided by GT will give you this answer. I am doing it by m plus. 1 divided by 1.1 is equal to m plus is equal to m plus is equal to m plus. 749,211 divided by MRC. 301,268. Machine B. Similarly, we need to do machine B, but it is for 2 years. 0, 1, 2, negative 4 lakhs. Running cost will be higher. 180, 180. All are cash outflow. There is a tax, so there will be tax benefit on depreciation. What will be depreciation? 4 lakh divided by 2. So 2 lakhs will be depreciation multiplied by 30%, which is 60,000 will be tax benefit on depreciation. 60,000 positive. 60,000 positive. Net cash flows will be negative 4 lakhs, negative 1,20,000, negative 1,20,000. Present value at the rate of 10%. This will be present value of cash outflow. 1 divided by 1.1 is equal to m plus is equal to m plus MRC multiplied by 1,20,000 plus 4 lakh. 6 lakh 8,264. Not a good answer for decision making, because one project is of 3 years, one project is of 2 years. I will be finding out equalized annual present value of cash outflow 68264 divided by 2 years annuity factor, which is 1 divided by 1.1 is equal to m plus is equal to m plus. In MRC, there is my factor 6,08,264 divided by MRC 35475 negative. Thus both are cash outflow. Lower is better. Which is lower? Machine A, equalized annual amount is lower. See, if you will see total, in machine B it is lower, but you cannot take total. This is cash outflow for 2 years. This is cash outflow for 3 years. They can never be compared. So we do that concept of equalized annual. Sir, we have not done a single question of equalized annual NPV. I agree. In equalized annual NPV, the concept will remain same. There is no question asked up till date, so we are not doing it. But it is the same. Instead of this figure, there will be NPV. And you need to take a decision of higher NPV. If the project life is different, then you need to take a decision by equalized annual NPV. This is the concept. This is equalized annual NPV, extremely good concept, because in practical life you will get projects which are different in duration. So there you will never find out only NPV, you will always find out equalized annual NPV. Let's start with capital rationing. C 5.4.1. A company has 1 lakh available for investment and has identified the 4 investment in which to invest. So what is investment in first project to be done? 40,000. It earns an NPV of 20,000. Investment in second project 1 lakh. If it wants to do all 4 projects, it will require 2,50,000 rupees. But they are having only 1 lakh rupees. See, 2 figures are given. It is C, D, E, F. You don't need to write it again because it is already given. Investment 40,000, 1 lakh, 50,000 and 60,000. What is given is NPV 20,000, 35,000, 24,000 and 18,000. Can you find out present value of cash inflow? This is present value of cash outflow. Investment is always present value of cash outflow. If cash outflow is given and NPV is given, you can always find out present value of cash inflow. It will be 60,000, because if present value of cash inflow is 60,000 and outflow is 40,000, NPV will be 20,000. This will be 1,35,000. This will be 74,000. This will be 70,000. In capital rationing, how to rank the project? We have learned it. The method is profitability index. By profitability index, I can give weight or ranks to the project. It is present value of cash inflow divided by present value of cash outflow. That is 6 divided by 4, which is 1.5. This is 1 lakh, 1.35 divided by 1 lakh. It is 1.35. 74,000 divided by 50,000. $1.48 and 78,000 divided by 60,000. It is 1.3. I will be ranking the project. First project will be project T. First rank is project C. Second rank is project T. Third is D. And fourth is, you are having 1 lakh investment. First 40,000 should be invested in project C. Second, you can invest 50,000 in second one. Remaining 10,000 should be invested in project D. What NPV you will generate? What NPV you will generate from project C? You are doing full project, so you will generate NPV of 20,000. Project E, you are doing it fully, so you will be generating NPV of 24,000. Project D, you are investing only 10,000 from 1 lakh. So you will be only doing 10% of project. So you will be getting only 10% of NPV. If you invest 1 lakh rupees, you get NPV of 35,000. If you invest 10,000, how much NPV you will be getting? This will be total NPV. It will be total NPV generated. It is a 47. This is not required. You are just required to find out the package of the projects. If the projects are independent and are divisible, we have found out the answer. If projects are divisible. If the projects are not divisible, then there is a problem. If projects are not divisible, which are the different options? You can do project C and E together. C and E together. So C plus E. You will use 90,000, right? If you can do D alone, because D cannot be combined with any other project. You can do E and F. No, it requires 1,10,000 and you cannot divide the project. You can do C and F. Yes, C plus F also you can do it. Only D, C plus E, C plus F, F plus E cannot be done together. Yes sir, can I do only C? Yes, but it will not generate enough NPV. How much NPV will be generated if you do C plus E? 20,000 plus 24,000, 44,000. NPV generated. Only D, 35,000. C plus F, 18,000 plus 20,000 is 38,000. Which project you should select if the projects are not divisible? Two projects, C plus E, and C plus E, your investment will be, total investment will be 90,000, which is within your budget. So if the projects are divisible, you will have to rank the project by PI. If the projects are not divisible, you will have to see the various combination and decide which project to be selected. Let us revise once again. I hope it is not the same question. No, it is the same question. It is same question, right? November 19, November 9. So it is just a repetition. 5.2.2 is excellent question. It clears your each and every concept of capital budgeting. It tests your real knowledge of capital budgeting rather than just the formula. Try to concentrate. Given below are the data of capital project M. Annual cost saving is 60,000. Useful life is 4 years. Internal rate of return is 15%. So you save annually 60,000 rupees for 4 years. This is your cash inflow. Internal rate of return profitability index is PI is given 1.064. Salvage value is 0. You are required to find out cost of project, payback period, cost of capital and net present value. Cost of capital is nothing but your required rate of return. Cost of capital is nothing but required rate of return which you need to find it out. Now, every year at the end of 1 to 4 years, there are cash flows of 60,000 every year. This is what is given. What is the cost of the project? We need to find it out. Correct. What is given? Useful life 4 years that we have considered. Internal rate of return is 15%. What does this mean? This project is earning 15% rate of return, or at 15% rate of return, NPV will be 0. So I am finding out present value at the rate of 15%. Find out present value of cash inflow at the rate of 15% of the 60,000. So it is 1 divided by 1.15 is equal to M plus 2, 3, 4. MRC multiplied by 60,000. 171,299. 171,299 is nothing but present value of cash inflow. Present value of cash inflow at the rate of 15%. And what we have decided, at the rate of 15%, my NPV will be 0. So how to find out NPV? Present value of cash inflow minus present value of cash outflow is NPV. At 15%, my NPV will be 0. So what will be my present value of cash outflow? 171,299. And 171,299 or 1,71,300 approximately is present value of cash outflow. Present value of cash outflow is nothing but cost, which is 171,299 rupees. See, a weird way, they are not telling you the cost of project. They have given you cash flow. They have given you IRR. And they are telling you to find out cost of the project. Cost of the project is 171,299. In fourth question, they are telling me to find out NPV. They are telling me to find out NPV. What is NPV? NPV is 0. We have found out NPV is 0. Yes or no? No. All right, you are correct. The answer is no, because NPV is 0 at IRR. At 15% NPV is 0. Whenever we want to find out NPV, NPV is always at required rate of return, which is not given. Required rate of return is given or not given? Not given. You need to find out cost of capital. So required rate of return is not given. Cash flow is given. Present value of cash outflow also I have found out. But how you will find out present value of cash inflow if the rate is not given? Then here is the point. PI is given. What is PI? PI is nothing but present value of cash inflow divided by present value of cash outflow. What is PI given? 1.064. What is present value of cash inflow? 171299. 171299. No. 171299 is present value of cash inflow at 15%. 15% is not my required rate of return. NPV and PI are found out at required rate of return and not at IRR. Both NPV and PI. So this is not my present value of cash inflow. This is present value of cash inflow at 15%. What I want, present value of cash inflow at required rate of return. Sir, what is required rate of return? We don't know. So present value, what is happening? It is present value of cash inflow divided by present value of cash. Present value of cash outflow is 171,299. At 15%, at 12%, at 10%, present value of cash outflow is always a present value. So it is 171,299. 171,299. So I will be getting answer of present value of cash inflow at required rate of return is 1.064 into 171,299. One seven one two nine nine multiplied by 1.06, 182,262. It is present value of cash inflow at required rate of return, 182,262. Now what is required rate of return? What is your cash inflow? From 1 to 4 years, it is 60,000, right? And we also know present value at the rate of required rate of return, present value of cash inflow at the rate of required rate of return is 182,262. Now I will be using trial and error method to find out what is my required rate of return. So discount this 60,000 by 15%. We have already discounted. It is 171,299. Discount it by 14%. Now I want to reduce that amount. So discount it by 14%. 60,000 at the rate of 14%. I am doing trial and error. 1 divided by 1.14 is equal to m plus 3 4 MRC multiplied by 60,000. It is 174,822. So 14% is not a correct answer. Try out with 13%. And then try out with 12%. At 12%, your present value of cash inflow will be 182,262 approximately. So 12% is nothing but a required rate of return. See, this question will take somewhat a time to understand. You can repeatedly see this question and try to understand. It is conceptually very good question to revise because it gives you an idea that NPV and PI are at required rate of return. You find out some NPVs at IRR also. At IRR, NPV will always be 0. What was given in the question? Cash flow and IRR is given. You can find out present value of cash outflow means cost of project. Then PI is given. You can find out present value of cash inflow at required rate of return. And from present value of cash inflow at the rate of required rate of return, you can just do trial and error and find out what is your required rate of return, which will be 12%. So it is a reverse question. All the answers are becoming question and questions are becoming answers. Also, in this question, you need to find out payback period. This I am keeping it upon you. All right. You need to draw 1, 2, 3, 4. Your cash flows are 60,000, 60,000, 60,000, 60,000. All right. I will have to find out present value at the rate of what? I want to find out payback period. 15% or 12%? 12%. 15% is IRR, not important. IRR is important just as an answer. The project is earning 15%. NPV and PI are calculated at discount rate at required rate of return, which is 12%. So find out cash flows. Let me do it. 60,000 divided by 1.12. I think my eraser is gone. 60,000 divided by 1.12. 53,571. 53,571. 53,571 divided by 1.12. 47831. I need to recover how much? 171,299. Okay. It is 47831 divided by 1.12. 42706. Divided by 1.12. 38130. 38130. I want to find out cumulative cash flows. Five three 571 plus 47831. 1,01,402. Plus 42706. 1,01,402 plus 42,706. 1,44,108. 1,44,108 plus 38,130. 182,238. I want to recover how much? Initial investment 171,299. 171,299 is my initial investment. It will be after 3 years, it will be recovered. So base year will be 3 years. Payback period will be base year plus 171,299 minus 144,108 divided by 38,130. Base year is 3 plus this. It is 171,299 minus 144,108 divided by 38,130. 38,130 plus 3.7 will be payback period. So I think this is one of the most important question as far as this type of questions are concerned, or understanding of payback period, present and NPV, IRR, profitability index is concerned.